What is capital gains tax when selling inherited property? Have you ever wondered what happens to taxes when you sell a property that you inherited? Let's break down the concept of capital gains tax in this context. When you sell inherited property, capital gains tax is the tax you pay on the profit made from that sale. The key term to know here is stepped-up basis. This means that for tax purposes, the property's cost basis is reset to its fair market value at the date of the original owner's death. For instance, if the previous owner bought the property for $100,000, but it was worth $500,000 when you inherited it, your cost basis becomes $500,000. If you sell the property for $510,000, your taxable capital gain is only $10,000. This is the difference between the sale price and the stepped-up basis. Without this stepped-up basis, you would owe taxes on the entire increase from the original purchase price to the sale price, which could be much higher. It is important to note that capital gains tax is only owed when you sell the inherited property, not when you receive it. The tax rate you face depends on your income bracket. Generally, capital gains from inherited property are considered long-term capital gains. This means they are taxed at rates of 0%, 15%, or 20%, depending on your overall taxable income. If the property is jointly owned and inherited by multiple individuals, the responsibility for capital gains tax is divided according to each person's ownership share. This can affect how much tax each person will owe when the property is sold. From the perspective of real estate investing, understanding how this tax treatment works is essential for planning the timing of the sale and evaluating potential profits. The stepped-up basis can significantly reduce the taxable gain, making inherited property potentially more advantageous to sell compared to property you purchased yourself. However, if the property appreciates significantly after you inherit it, you will owe capital gains tax on the increase from the stepped-up basis to the sale price. In summary, capital gains tax on inherited property is calculated based on the difference between the sale price and the stepped-up basis, which is the fair market value at the time of inheritance. This tax is triggered only upon sale, and the rates apply as long-term capital gains, regardless of how long you hold the property after inheriting it. Understanding these details can help you make informed decisions in your real estate investments.